The ethical challenge: secrecy versus confidentiality. For bankers, one of today's key ethical dilemmas centres on banking secrecy, which in times past was thought of as a given. But was such a time really a golden age of banking? Is banking secrecy ever justified? Can we legitimately help customers and clients hide money or information from governments? Does society have a right to insist on transparency in our transactions, even if that breaches our duty of confidentiality in our handling of a client's private information? These questions have been rendered both starker and trickier by the changing geopolitical landscape since the global financial crisis. On the one hand, there's a growing international acceptance that banking secrecy must not be permitted to hide illegality of any kind, from money laundering, tax evasion, to the funding of terrorism. The 2013 US Foreign Account Tax Compliance Act, also known as FATCA, for example, makes it more difficult for US taxpayers to conceal assets held in offshore accounts and shell corporations. Similarly, the European Union Savings Directive in the same year aims to counter cross-border tax evasion by collecting and exchanging information about foreign resident individuals receiving savings income outside their resident state. Simultaneously, there's an equally powerful personal urge towards appropriate confidentiality. No sharing of my data with other providers without my permission. No cross-selling or marketing of bank services without my explicit say-so. We righteously demand more transparency about others. We virtuously insist that less should be hidden by others. But for ourselves, our instinct is to quarantine our own interests and limit the information we're prepared to share. There's an unavoidable tension between the public interest and my private interest. Tax evasion and avoidance. For bankers, this tension poses a real ethical dilemma. The 2008 financial crisis highlighted rising popular concerns about the ways in which banking secrecy has facilitated sophisticated methods of tax evasion and tax avoidance. Wealthy people, well-heeled companies aren't paying their fair share. And since then, pressure groups and government agencies have sharpened everyone's critical understanding of the scale and nature of worldwide revenue losses incurred through these secret routes into offshore tax havens. As little as 20 years ago, there was scarcely any debate about banking secrecy. Even in Switzerland, that bastion of banking's closed book, it took huge pressure from the US gradually to force open the banking doors in Zurich, Basel, Bern and Geneva. In October last year, the Swiss government finally announced its intention to sign an OECD-sponsored agreement to end the special secrecy that clients of Swiss banks have so long enjoyed. This trend away from secrecy has helped to crystallize perceptions of how the duty of bankers can, and arguably should, be curtailed by their social responsibility. A bank certainly does have a fiduciary duty to investors legally to minimize its own tax bill. But we insist that our own bank takes a principled lead in refusing to facilitate aggressive tax planning by our customers and clients. Our view is that being a steward of a customer's best interests is overridden by the legal responsibility not to evade tax, as well as a social responsibility not to aggressively avoid tax. On the contrary, the BSB aims to set an example by proactively working with governments and international agencies to try and close tax loopholes, not to identify new ones and help clients to exploit them. Ultimately, this is about having a license to operate within a society. In the final analysis, our bank's social responsibility has to trump its responsibility towards an individual client's rights to privacy and secrecy, if that client has been engaged in tax evasion or very aggressive tax avoidance. If clients want to engage in that sort of business, we won't service them. Others may, but that's their moral choice. But of course, the contemporary character of money has also altered perceptions of its management, particularly for individuals. Past generations would deposit their silver plate, their jewellery, and above all, their cash in their bank's vault for safekeeping. These days, though, money itself has become, for the most part, an electronic commodity that's no longer stored in bank vaults. What's held by banks today is something much more valuable. huge volumes of digital information about their customers and their access codes. Banks now are essentially information stores, and today's key question is whether customers are sufficiently confident about the security of their legitimate private information to trust banks to hold it. Or will some other agent, Apple say, become far more trusted to hold our personal information, including our electronic money? It seems to us that the key operational issue for banks concerns the practices we must perform to enhance customer trust in us as guardians of the personal information we now hold. If banks, for example, continue using the customer information they hold simply to cross-sell products that their customers don't feel they need and are not truly in their best interests, then it won't be a surprise if people are less and less inclined to let banks hold their information at all. A bank manager, seeing that a customer has, say, £150,000 in her current account, might appropriately call her as a trusted advisor to suggest she'd earn a better return if that money was in a savings account. Conversely, when the bank's head of marketing demands details of those who've taken out recent loans so his team can sell them insurance, you can see how appropriate it would be to tell him to get lost. Seen this way, it's relatively straightforward to define the paramount ethical duty of a bank as the steward of a customer's money and information. The bank can only use that information either with the customer's permission or where it's genuinely in the customer's best interests. We expect that these active consents will become a more frequent and more typical part of standard client agreements. Our operating assumption is that banks are not secret institutions. They are transparent about what they do. They treat customers' information with respect and confidentiality, understanding that there are times when the public interest overrides that need for confidentiality. In particular, banks and their customers understand that they can't hide tax evasion or aggressive tax planning behind an inappropriate cloak of confidentiality. Our idealistic assumption is that if you're hiding something, it's because you're ashamed of it. The banks of the future should not be ashamed of anything. Thank you for listening. Please visit our other case studies and discovery sessions in the ECC, Ethics, Culture and Conduct Toolkit, and share your views with other session participants on our discussion forum. Remember to record your time as professionalism and ethics on your CPD logbook.